September 15th, 2008. Lehman Brothers, the fourth largest investment bank in America, files for bankruptcy. In a single day, the market loses $500 billion. Over the next 6 months, 4 million Americans will lose their homes. Retirement accounts across the country will get cut in half. People who did everything right, saved, invested, listened to their advisors, will wake up and find that half their money is gone. And right in the middle of all that, Warren Buffett picks up the phone and calls Goldman Sachs, not to pull his money out, to put money in. $5 billion. At the bottom, on terms no company would have accepted in normal times. 10% annual return, guaranteed, plus the right to buy shares at a locked-in price once the market recovered. When they asked him why, he said one thing: be greedy when others are fearful. Sounds like a clever line, but it's not a line. It's a strategy that's almost 500 years old. Buffett didn't invent anything new. Before him, Rockefeller did the same thing. Before Rockefeller, the Rothschilds. Before the Rothschilds, the Medici. 4 families, 4 eras, the same playbook. And in a few minutes, you'll know exactly how it works. To understand what Cosimo de' Medici did, you first need to understand what happened to the people who came before him. 14th century Florence, the banking houses of Bardi and Peruzzi, the biggest in Europe. They lend to King Edward III of England, finance wars, move enormous sums. One bank, one balance sheet, one decision-making center. When Edward refused to pay his debts and he owed nearly 1.5 million gold florins, both houses collapsed completely. The shock wave hit all of Florence. A chain of bankruptcies rippled through the city, and the consequences lasted decades. Cosimo de' Medici grew up on that story. He knew what happens when you put everything in one basket. When he took over the family bank in the 1430s, he did something no other banker of his time was doing. He didn't build one big bank. He built a network. By 1455, the Medici had branches in 10 cities: Florence, Rome, Venice, Naples, Milan, Pisa, Geneva, Lyon, Bruges, and London. And every single branch was a separate legal entity, its own capital, its own books, its own local partners. Branches charged each other commissions as if they belonged to different owners entirely. Why? Because Cosimo understood something his competitors didn't. If everything is connected, everything falls together. When the London branch lost big on loans to the English crown, it went under. But Florence didn't flinch. Rome didn't notice. The family's money was divided by walls that no single crisis could breach in one blow. 300 years later, the Rothschilds did the same thing, but on the scale of an entire continent. Meyer Amschel Rothschild sent his 5 sons to 5 capitals: Frankfurt, London, Paris, Vienna, Naples. Each one ran his own branch independently. When Napoleon redrew the map of Europe and wiped out half the banking houses on the continent, the Rothschilds survived every move because no single node was the only one. Bring that into the present day. Berkshire Hathaway isn't one company. It's a holding structure with more than 60 separate businesses. Geico could go bankrupt. Burlington Northern wouldn't even notice. Dairy Queen could shut down. It wouldn't touch See's candies. Same architecture as the Medici. Same logic. No single hit should ever be the last one. This is probably the most counterintuitive thing wealthy families do. When the market is climbing and everybody around them is making money, they hoard cash. From the outside, it looks like cowardice or stupidity. The market is up 20% a year and you're sitting on cash earning 2. Your neighbor is bragging about returns. Your advisor says you're missing opportunities. But here's what old money knows that your neighbor doesn't. Cash isn't just paper for a rainy day. Cash is a weapon, and it only fires once at the exact moment when everything around you is falling apart and nobody else has any ammunition left. The Rothschilds, before Waterloo. All of Europe was pouring money into war contracts. profitable as long as the shooting continued? Nathan Rothschild in London spent years quietly buying gold and stacking liquid assets. No fanfare, no headlines. By the spring of 1815, the combined assets of the five brothers stood at £500,000. A year later, 1 million doubled. Not because they pulled off one brilliant trade in a single evening, but because they'd been building a war chest for years and deployed it at the right moment. We'll come back to what exactly they did with it. 60 years later, Cleveland, Ohio, the panic of 1873, oil companies going bankrupt left and right, the credit market frozen solid, everyone scrambling for cash, and Rockefeller. He had cash. Standard Oil was one of the few companies in the industry with money on the balance sheet. His competitors were hunting for loans just to stay alive. Rockefeller wasn't hunting for loans. He was making offers, not loans, buyout offers, on his terms. Fast forward to today. At the end of 2024, Berkshire Hathaway is sitting on over $300 billion in short-term treasuries and cash. That's more than the entire GDP of Finland. Analysts write every quarter that Buffett has lost his edge, that he can't find anywhere to invest, that holding that much cash is an inefficient use of capital. He doesn't comment. He waits. Liquidity is patience translated into money. Big fortunes aren't made in the good years. They're made in the bad ones, by the people who are ready. 1870s, Cleveland, Ohio. John D. Rockefeller is building an oil empire, but he's not buying shares in oil companies. He's buying the refineries themselves, the pipelines, the railroad cars, the storage tanks. Why? Because a stock is a promise, a piece of paper that says you own a share of something. But when panic hits, promises lose value first. The market drops and your share is worth half as much. Even though the refinery is still standing, the pipeline is still pumping, and the rail cars are still running. By 1882, the Standard Oil Trust controlled 90% of refining and most of the pipelines in the country. When the panic of 1893 crushed the markets, his refineries kept pumping at the same volume. Other companies' stock prices collapsed. His physical assets didn't. The Medici understood this long before Rockefeller. When their bank collapsed in 1494, the family was thrown out of Florence. The bank was seized. The money in the accounts confiscated. But the villas, the land, the buildings, those stayed. You can't bankrupt a building by decree. You can't void a vineyard. And it was on that foundation, not bank accounts, not promissory notes, that the next generation of Medici came back and became even more powerful than before. Look at the largest family offices in the world right now. Throughout the 20s, they've been buying up farmland, ports, data centers, water infrastructure. Bill Gates is the largest private landowner in the United States. About 270,000 acres of agricultural land. That's not a farming hobby. It's the same logic Rockefeller followed 150 years ago. Land grows food. Food is always needed. Land doesn't go to zero. Paper promises. Real assets just are. 2008, two people. The first, a retiree, 62 years old. Portfolio, split 60-40 between stocks and bonds. His advisor said it was safe. It was the standard approach. By March of 2009, he'd lost 40%. Half his retirement gone. He did everything by the book. The second, a client of one of the largest family offices in the country. Starting in 2006, they've been trimming real estate exposure and building up cash. When Lehman went down, they were in the green. Not because they guessed the exact date, because they'd been preparing for the fact that someday a date like that would come. Everything we've talked about so far, diversification, liquidity, real assets, sounds like common sense. And it is common sense. Any decent financial advisor would tell you roughly the same thing. But common sense is just the entry ticket. It protects you. It doesn't make you richer. The difference between someone who held on to their money through a crisis And someone who came out of it wealthier than they went in isn't what they did before the crash. It's what they did when everything was falling apart. Regular people freeze when panic hits. Old money accelerates. June 18th, 1815. Waterloo. The London Stock Exchange is frozen. If Napoleon wins, British bonds collapse. If he loses, they soar. There's a popular legend about how Nathan Rothschild tricked the market, supposedly started selling bonds, triggered a panic, then bought everything back at the bottom for pennies. Great story. But historian Niall Ferguson, who studied the family archives, showed that reality was both simpler and more interesting. The Rothschilds did receive news of Wellington's victory a full day before anyone else in London. Not because they bribed generals, because they'd spent years building their own courier infrastructure across the continent. A Rothschild agent left Dunkirk on the night of June 18th, crossed the channel on one of the family's fast vessels, and by the night of the 19th, Nathan already knew. Wellington's official messenger didn't reach London for another 2 days. But here's what Nathan actually did. He didn't pull off an overnight speculation. He bought British government bonds massively, patiently, over weeks. He calculated that the end of the war meant less government borrowing, which meant bond prices would rise. He held them for 2 years, sold in 1817 at roughly a 40% profit. At the volumes and leverage the Rothschilds were working with, it was one of the largest trades in financial history. 60 years later, Cleveland, the panic of 1873. Oil companies going bust one after another. Their owners, yesterday's millionaires, ready to sell at any price just to get something back. Rockefeller buys, not one company, dozens. Refineries, routes, contracts. In a few years, he turned Standard Oil from a major player into a monopoly controlling 90% of American refining. Not because he was a genius, because he had cash when everyone else had debt. 2008. Buffett, Goldman Sachs, $5 billion for preferred shares at 10% annual yield, plus warrants to buy common stock at $115. General Electric, same kind of deal. Bank of America, another $5 billion on identical terms. Roughly $15 billion deployed at the bottom of the crisis. Tens of billions earned over the next 5 years. 3 eras, 3 men. The same move. While everybody sells in panic, buy. But that move is impossible without the first 3 chapters. Without diversification, you're in trouble yourself. Without liquidity, you've got nothing to buy with. Without understanding real assets, you don't know what to buy. This isn't greed. It's preparation that looks like greed at the moment it pays off. We already mentioned the Rothschild courier network, but it's worth stopping to understand the scale of what they built, because this principle is one of the most underrated. The Rothschilds maintained their own courier fleet, ships stationed in Dover, Calais, and Ostend, ready to sail at any moment. Relay horses on every route from the coast to London, a carrier pigeon farm in Hythe, a network of agents in every major port and capital in Europe. It cost a fortune, and for years, it looked like a pointless extravagance. Why spend that much on delivering letters? And then came the evening of June 19th, 1815, and the speed they'd been paying for over the years paid for itself in a single night. The Rothschilds didn't steal information. They built infrastructure to receive it. Those are different things. They didn't know anything forbidden. They simply knew faster. The Medici did the same thing 3 centuries earlier, just with different tools. Cosimo de' Medici personally knew every cardinal, every important banker, every merchant with real influence. When the papal court shifted its policies, and in the 15th century, papal decisions moved markets no differently than the Fed does today. The Medici heard about it first, not because they paid spies, because they were in the room when it was being discussed. Rockefeller dined with the bankers who then gave him loans on terms nobody else could get, not because he blackmailed them, Because he'd spent years building those relationships and they trusted him. There's a thin but critical line here. In 2012, the hedge fund SAC Capital, run by Stephen Cohen, was fined $1.8 billion for insider trading. The difference between what the Rothschilds did and what Cohen was punished for comes down to the source of the advantage. One family built their own network. The other used someone else's restricted information. The line is thin, but in the eyes of the law, it's absolute. And today, the biggest family offices share research among themselves. Closed investment clubs swap observations. Syndicates get into deals before they hit the public market. This isn't conspiracy talk. It's simply a different speed and quality of information available to people who invested in their circle. And here's what matters for an ordinary person. You don't need an invitation to Davos. You need 5 to 10 people who think seriously about money, who read what most people don't, and who share observations before they make the headlines. That's available to anyone. And it's an asset that can't be seized or inflated away. Before we get to the last principle, it's worth talking about what none of these families ever did. Because sometimes the most important thing isn't what you do, it's what you hold yourself back from. They didn't use leverage in good times. When the market was rising and everyone around them was borrowing to earn even more, old money didn't touch margin. Rockefeller could have doubled his positions on credit and didn't. The Rothschilds could have invested 10 times what they had and didn't, because leverage is a mechanism that multiplies gains on good days and wipes you out on bad ones. And bad days were exactly what they were preparing for. They didn't speculate on things they didn't understand. Nathan Rothschild traded bonds, gold, and currencies, things he understood better than anyone in London. He didn't chase Dutch tulips. He didn't bet on South American mines. When the South Sea Company dragged down the fortune of Isaac Newton in 1720, one of the greatest minds who ever lived, the Rothschilds wouldn't have touched anything like it. They made their money on what they knew, inside and out. They didn't hand control to people with no skin in the game. Cosimo de' Medici didn't pay his branch managers a salary. He gave them a share of the profits. Every director invested his own money into his branch. If the branch failed, the director lost personally. That's not a minor detail, that's the foundation. When someone is risking other people's money, they take different risks than when it's their own on the line. 3 things. Don't borrow in the good times. Don't bet on what you can't explain. Don't trust your money to someone who loses nothing if it all goes wrong. It sounds simple. But think back to 2008. Banks were running leverage at 30 to 1, trading derivatives they couldn't explain to their own boards, and the bonuses went to the managers while the losses fell on shareholders and taxpayers. 3 rules, all 3 broken. You know how that ended. Cornelius Vanderbilt died in 1877 as the richest man in America, $100 million. In today's money, that's roughly $2.5 billion. His fortune looked unsinkable. Less than 100 years later, when 120 Vanderbilt descendants gathered for a family reunion, not a single one of them was even a millionaire. Where did the money go? Mansions on Fifth Avenue, yachts, divorces, bad investments, and above all, not a single mechanism to stop the next generation from burning through what the previous one had built. There's a statistic that everyone who works with serious money knows. 70% of family fortunes are gone by the second generation, 90% by the third. Grandfather builds, son maintains, grandson blows it. The Chinese even have a saying for it. Wealth doesn't survive 3 generations. But the Medici ran in Florence for 3 centuries. The Rothschilds have been wealthy for over 200 years. The Rockefellers, 7 generations. And the family capital is still working. How? Not because their heirs happen to be more disciplined than everyone else's, but because the structure didn't give the heirs a chance to destroy everything. The Rockefellers created 2 key trusts in 1934 and 1952. The setup is straightforward. The capital works, it generates income. The family lives on that income, but the capital itself is untouchable. No single heir can cash out their share. Rockefeller and Company manages the assets centrally. The result? 7 generations later, the family's combined wealth is estimated at over $11 billion. The Rothschilds went even further. In the 1810s, the 5 brothers signed a family agreement. No branch of the family could withdraw from the shared capital pool. You want to leave? Leave. But you don't take your share. It stays in the common enterprise. That sounds harsh, but it's exactly why the Rothschilds survived the Napoleonic Wars, the revolutions of 1848, 2 world wars, and the financial crisis of 2008. As a single structure, not as 50 separate heirs pulling the blanket in every direction. The Medici used a different mechanism. They invested in things that are impossible to blow through. Churches, works of art, buildings, reputation at the papal court. Michelangelo lived in the Medici palace from the age of 17. The dome of the Florence Cathedral, that was a Medici project. This wasn't charity. It was capital converted into a form that no heir could burn through in a single night, and that kept working for the family across centuries. Here's the irony. The biggest threat to a large fortune isn't a crisis. A crisis lasts 2 or 3 years. The biggest threat is an heir with no structure, no restrictions, and full access to the money. That's forever. The Rockefellers figured this out. The Rothschilds figured it out. The Medici figured it out. The Vanderbilts didn't. 6 chapters, 4 families, 500 years. The details are different every time. The Medici ran banks out of Tuscan palaces. The Rothschilds traded bonds in London offices. Rockefeller built oil refineries in Ohio. Buffett calls from Omaha. But the playbook is the same. Break it up so no single hit is the last one. Stack liquidity while everyone else chases yield. Own what's real, not what's promised. Buy when everyone runs. Know before the headlines. Through people, not through the news. And think in generations, not quarters. Cosimo de' Medici built a bank across 10 branches. Nathan Rothschild bought bonds the week after the battle. Rockefeller scooped up his competitors in a panic. Buffett called Goldman at the bottom. 4 people, 4 centuries. Not one of them did anything that's out of your reach in principle, only in scale. You won't become a Rothschild. Neither will I, but scale doesn't matter. A person with 500,000 and a person with 5 billion are subject to the same laws. Money doesn't respect size. It respects structure. 500 years of changing currencies, empires, and technologies. The playbook hasn't changed once. Drop in the comments. Which of the 6 principles do you think matters the most and why? I'll pin the most interesting answers. I'll see you in the next one.